So now that we have our PCRs done, we still need to put this stuff on the books. The production costing report is just a document that helps accountants make sure they know where all the costs are at, that every dollar is accounted for, and they have information that tells them how it should be separated between the different departments, what goes to finished goods, etc. So while it's a very important document to make and you have to make it, it doesn't actually put it on the company's books. That happens through journal entries in the general ledger. So we're going to have to record all of the journal entries for all of the stuff that happened in Chew Easy during this period. One of the things that we're going to have to do eventually when we get there is figure out what our cost of goods sold is. In the way that inventory works under GAAP, you can't expense the cost of buying materials or paying for labor, etc. at the time it's incurred if it's related to production. You have to value it in your inventory accounts, and you record all of the expenses related to inventory when it's actually sold. And what gets sold is finished goods. So you can figure out what your cost basis is per unit when you have by looking at the PCR for the last department in your production line. In our case, that was the jarring department. And in the jarring department, you would go to the area for units that were completed and transferred out, and it would tell you how much of each cost component went into those jars that were completed and transferred off to finished goods to be sold. And on our PCR for the jarring department, we determined that each case worth of peanut butter cost $4.40 in costs, which were transferred into the jarring department from the peanut preparation department. And then the jarring department added 50 cents in material costs and 40 cents in conversion costs. So all in all, that's $5.30. Each case of peanut butter that was completed and finished and ready to be sold, transferred off to finished goods, cost Chew Easy $5.30. So when they sell units during the period, the cost that they get to record, the expense that they get to have, is $5.30 for each case sold. So we're going to very much need that entry later on when we get to the COGS entry. The problem is we can't record COGS right now. Why not? Because none of the other stuff is on the books. We haven't recorded the purchase of materials, the usage of materials, the transfer of costs from one department to another. So we're eventually going to use that $5.30 per case when we get to COGS, but first things first, we got to get everything else on the books. And I always do this in some kind of chronological order on how it would naturally work in the department. The first thing you need to do before you can even use materials is buy them. So let's record the entry to purchase our materials for the period. We're making a purchase of $175,000 of materials on account. So how would we record this in the entry? The same way you record the entry for the purchase of any type of inventory. It's always a debit to your inventory account. In this case, we're buying raw materials, so we can put it into raw materials inventory. And over a credit of how you're paying it. Since this was on account, we would put it in accounts payable for $175,000. And this is our entry where we purchased raw materials on account. On most companies' books, you won't have just one raw materials inventory account. You would have a sub-account of raw materials inventory for every single thing that you use in production that's a direct traceable material. So we would have like raw materials inventory dash peanuts, raw materials inventory dash jars, dash lids, any single part. Now that's the way you want to do it because it lets you know how much of each piece of inventory that you have at the end of the period. But for an AC116 student at MVCC, it also means that every entry you record, if you're a big enough production company, might be like 20 lines tall with debits, and nobody wants that. So we're going to have just one debit to a raw materials inventory account. But now those raw materials are on our books, and we can record the actual usage of them during production. So your second step is to assign all of the costs that were assigned in each department according to their PCR. We had a PCR for the peanut preparation department. And on the peanut preparation department's PCR, we determined that $130,200 worth of costs were added by that department during the period. In other words, they took $130,200 worth of peanuts out of their raw materials and started preparing them in the process of making completed, finished, sellable cases of peanut butter jars. Looking at the jarring department's PCR, that was $19,000 worth of materials costs that were added by that department during the period. So you would go to the PCR, figure out what the material cost added was by each department, and then you record it on your books with a debit to that department's WIP subsidiary account. So you would have a debit to WIP inventory dash preparation for how much was added to the peanut preparation department's PCR during the period, 130,200. Same process would lead us to a debit to WIP inventory dash jarring for the $19,000 of costs added by that department during the period. And then you'll have the usage of indirect materials that happen during the period. That can't easily be traced. We need to just pull it up into our indirect cost pool, and we'll spread it out later on. And our indirect cost pool, as always, is manufacturing overhead. Manufacturing overhead has actual costs recorded with a debit, and this is definitely an actual cost because we still need to pay for all those indirect materials that got used in production. So now I have all my debits. What's my credit going to be to? Well, what account did it come out of? It came out of raw materials inventory. So we would have a credit to raw materials inventory for the total amount that came out of all of these different things, the total amount that went to the preparation department and the jarring department, and the total amount of indirect materials used. And raw materials inventory gets credited for $151,200 to reduce that account in this entry where we assigned material costs to the respective departments during the period. So first cost component down, materials. Let's move on to the second cost component, which is labor. On the PCR, I'm going to have you guys use the common format of having a conversion cost column on there, but there is information that tells you what portion of those conversion costs can be attributed to labor. And we know, as we were working our way through this, that the amount of labor costs that were assigned to Chew-Easy's peanut preparation department was $22,090, and it was $3,840 for the jarring department. Just like before, those are costs that were incurred in the process of making this inventory. So we would start with a debit to WIP inventory for each of the departments for the amount that department incurred in direct labor costs during the period. And then if we have indirect labor costs, which we do down here, they accumulated $1,500 worth of indirect labor costs. That is still a very actual but untraceable expenditure that we have. We would throw it in our manufacturing overhead, how we throw all actual costs into that account, and that is with a debit. So we would have a debit to MOH for $1,500. And then your credit is to how it's being paid. And in our case, to make things simple, we're going to say that all these costs were paid in cash. So our credit's going to be to cash for that total of $27,430. And now our books have all of the material costs and all the labor costs that went into production during the period in the different departments' respective inventory accounts. So we need to account for the third cost component, which is our overhead costs. Let's first record the actual overhead costs that we had during the period. We incurred $30,000 in machinery depreciation. We paid $15,000 for rent, and we paid $4,000 for utilities. And the rent and utilities were paid in cash. Well, these are all actual expenditures that are going to go in here, so we're going to start with a debit to manufacturing overhead for the total amount, which is $49,000. And then you'll have credits to all the accounts that need to be affected that relate to the reasons that you had overhead during the period. For us, our biggest chunk of overhead came from that $30,000 in depreciation that we had on our machinery account. Like, it's recorded to accumulated depreciation of our machinery, increasing that contra asset for $30,000. And then the two other items, the rent and utilities, we paid for in cash, so to account for them, we need to decrease our cash account by the $19,000 that we pay for those two cost components when we incurred actual overhead costs. So now that's on the books. Let's spread it out to the jobs and the allocation process. We're going to use a predetermined allocation rates. Again, you always make your best guess on what your amount of overhead is going to be during the period. You come up with some logical methodology, a cost driver, if you will, to spread those costs amongst the different components of your business. We're going to spread them to our two different departments. And when we did that, when we mathed it out, we determined that $42,000 worth of overhead costs needed to go in the peanut preparation department and $11,000 needed to go to the jarring department. So let's start with a debit to WIP inventory, peanut preparation department, for the amount that was allocated to that department, which was $42,000. We would have another debit to WIP inventory, this time for the jarring department, for the amount that was allocated to that particular department, which was $11,000. And all of this is coming out of our manufacturing overhead account. So manufacturing overhead, actual costs go in on the debit side, and when you take those actual costs out and put them into the different phases of production that you have, they get allocated out on the credit side, and we have to credit manufacturing overhead for $53,000. And here we allocated overhead to our WIP, to our work in process. At this point in time, Chew Easy Peanut Butter has all of the costs that were related to work in process inventory on the books. All of the material costs and all the conversion costs, our labor and our overhead, are in WIP, but they can't stay there because not all of it is tied up in WIP during the period. Costs got transferred from one department to another. Some units got finished and costs got transferred out of our WIP inventory to finished goods, so we need to record a couple entries to account for that. The first one is going to be the transfer of units. Chew Easy Peanut Butter is going to transfer 40,000 units from the first department, peanut preparation department, to the second department, the jarring department. And we know from the peanut preparation department's PCR and the jarring department's PCR that the amount of cost that got transferred between the two different departments that we had was $176,000. We got to affect the respective subsidiary accounts for WIP for these two different departments to move it out of the first phase, the peanut preparation, and into the second phase, the jarring department. Well, WIP inventory is an asset, goes up with the debit and down with the credit, which means we're going to debit the department's WIP account that it's going into and credit the department's WIP account that it's coming out of. So every time that you transfer costs, it's a debit to the WIP sub-account for the department that you're transferring the cost into over a credit to the WIP sub-account for the department you're transferring out of. And this entry records the $176,000 worth of cost that we transferred from the peanut preparation department to the jarring department during the period. And this would reduce the amount of WIP that we have on the books related to peanut preparation to what actually ended up in that department at the end of the period. And now we got a bunch of WIP costs in the jarring department. But the jarring department, not everything is a work in process. They finished some goods as well. And they completed and transferred out 38,000 cases of finished sellable peanut butter during the period. On their PCR, the total amount of costs that got transferred out during the period was $201,400. So if they're the last phase of production, it's no longer a work in process. We got to transfer those costs to our FG, or finished goods inventory, for $201,400. And since it's no longer a work in process within the jarring department, we got to reduce the jarring department's WIP sub account by $201,400 to bring that account down to the actual amount of costs that are still committed to units that are a work in process in the jarring department at period's end. And we completed units and assigned costs to finished goods inventory. So it's pretty much how it flows through the production process. If you're using process costing, doesn't matter how many accounts that you have, how many different departments, you're always going to be taking out of the first phase and putting it into the second phase by debiting the account that's going into and crediting the account that's going out of. And you'll continue to do this no matter how many phases of production that you have until you hit that last phase of production. And when you hit that last phase of production, instead of transferring to another department's WIP inventory account because there isn't another department, you transfer to finished goods because the process has been finished. And now, with all that on the books, you can finally sell your stuff. So during July, let's say that Chew Easy sold 35,000 cases of peanut butter on account for $8 per case. Well, that's the standard form entry to make a sale of anything on account, which is always AR over sales revenue. In this case, it would be for $280,000 because we're selling 35,000 cases at $8 a piece. So that first entry records the sale of the $35,000 worth of 35,000 cases of peanut butter that we had sold during the period. And now we finally get to expense our costs of production. And we determined on the very first slide of this part of the presentation that our cost per case was $5.30. And it again would just be the sum of your cost per equivalent unit for transferred out on the last phase of production. We came up with $5.30. So those 35,000 cases cost us $5.30 a piece, and that's how we expense all the manufacturing costs to cost of goods sold at the time the sale is made. So here, 35,000 cases at $5.30 a piece is $185,500, and we no longer have those finished, completed cases of peanut butter ready to be sold. So we need to reduce our finished goods inventory account by that same amount of $185,500, and that journal entry to assign COGS to our books for the units that we sold. And now our books have all the stuff moving through. Like after we recorded all these entries, the WIP balance of each department's sub account should be equal to the actual amount of cost you have committed to inventory that's still work in process. The balance of finished goods inventory will be equal to the actual amount of finished cases that you have during the period, the cost of producing those cases, and the amount you have in cost of goods sold is how much cost you paid to produce the units that you actually sold during the period. So you're spreading your costs out to all of the different accounts where it should be at period's end.